everyone, welcome back to SNN channel. Hope everyone is doing well. Stock market has always been volatile depending on the good news and bad news relating to the company. Generally, it is just the market sentiment whether the investors are bearish or bullish over the future outlook. Understand that the China crackdown has been a heat issue that affecting some big technology stocks such as Alibaba, Tencent, Meituan. The value was lower by more than 40 to 50% year to date. So what will be the alternative of investment if you do not want to feel the emotional roller coaster and still want to make something out steadily in the stock market? While there is certainly risk of losing money in the market, but the risk is way lower if you diversify and invest for longer term. What are index funds? Index funds are the easiest way to diversify portfolio. As we know, the Standard & Poor's 500 index, or simply S&P 500, comprise of 500 of the largest, strongest and most stable companies in the United States. S&P 500 funds are designed to mirror the performance of the S&P 500 companies by using the index as benchmark and replicate the performance of the S&P 500 very closely. If you invest in the index funds, you will get the exposure of the 500 strong companies. How to invest in the index funds? You can buy either the mutual funds or the exchange traded funds ETF. The difference is that ETFs are listed on the exchange and can be traded throughout the day like any other stocks. Mutual funds have different structure where investors may only be able to buy at the day's closing net asset trading price. Each fund certainly will incur expenses, and hence the S&P 500 outperform the index funds slightly depending on the expense ratio. Here are the top 3 popular index funds that you could put into your watch list. We break it down into expense ratio, total asset under management, and their annualized return over the past 5 years and 10 years for quick comparison. The 3 popular S&P 500 ETF are Vanguard S&P 500 ETF, iShares Core S&P 500 ETF, and SPDR S&P 500 ETF Trust. They are all listed on the NYSE, New York Stock Exchange. Here are the tickers for your reference if you want to do a research and save it in your watch list. Quick overview. SPDR S&P 500 ETF Trust has the longest history of launching the fund since 1993. Issuer is the State Street Global Advisor. iShares Core S&P 500 ETF is issued by BlackRock Financial Management since year 2000. And Vanguard S&P 500 ETF is launched by Vanguard since year 2010. By looking at the fact sheet, we can have a quick look at the historical performance and expense ratio. Based on the most recent publicly available information in their website, Vanguard is having a total funds assets of $805 billion. iShares Core S&P 500 ETF total fund assets is $307 billion, and SPDR S&P 500 ETF is $403 billion. In terms of expense ratio, Vanguard and iShares are the most attractive by having relatively lower expenses ratio at 0.03%, while SPDR is having higher expense ratio at 0.09%. It means for every $1,000 invested, expect $30 will go into paying admin and operating expenses to the fund administrator. The lower it is, the better for the investor. Let's take a look at the historical performance. The actual 5-year annualized return of S&P 500 is 17.65% and 10 years annualized return is 14.84%. While these index funds are performing very closely to the benchmark, just slightly lower because of the operating expenses. As Vanguard is having lower expense ratio, it has outperformed the other 2 index funds very slightly by less than 0.2%. Overall, all funds historically able to achieve above 17% annualized return over past 5 years and 14% annualized return over past 10 years. The market price of these 3 ETFs now are trending upwards to more than $400 from the sharp drop last year in March 2020, which was as low as $220. Investing in ETF can be a long-term strategy if you invest consistently using dollar cost averaging without being affected by the up and down in the market. The 10 years return is about 14% and the 5 years return is about 17% per annum. This may not sound exciting if you have more attractive return in other individual stocks, but still, this is a good way to diversify your portfolio without doing excessive research on the stock. That's just our view. Alright, that's all on the sharing of the ETF. On top of this, if you are interested in investing in mutual funds that tracks the S&P 500, do also check out Fidelity Zero Large Cap Index and Swap S&P 500 Index Funds. As they are also having relatively lower expense ratio, do note that some of the funds may require minimum investment amount and check if there are any sales load chargeable. The reason for investing in ETF is that it is more straightforward. You can buy it like other stocks from the exchange market and not to worry about any sales load. Hope you guys enjoyed this video and find this helpful to kickstart your investment journey. See you again in the next one.